Good morning and welcome to our look back at the FOMC decision last night and the subsequent press conference with Jay Powell. Now, the Federal Reserve, as expected, cut rates by 25 basis points, setting the federal funds target range between 1.5 and 1.75%, which is the third straight rate cut in this cycle, a third straight rate cut over the summer, really. But they're pausing. So they changed the forward guidance. They're no longer saying that they're going to act as appropriate to sustain the expansion. Instead, they're going to look at the incoming data and assess what that impact should be on monetary policy. So, in other words, they're saying, we're done for now. We've stopped cutting. We're going to look at the data. We're becoming data dependent again. And we'll see how things evolve. And we may cut again. Now, that was taken by the market as pretty dovish, actually. Although they're pausing the rate cutting cycle, and some in the market, certainly the expectations were that there could be another cut in December. Overall, it's quite a dovish statement because on the other side, Jay Powell in the press conference made it very, very clear that the Federal Reserve will not be hiking rates soon. He said that really you need to see a sustained, meaningful uptick in inflation. It needs to be persistent, and that's just not going to happen at the moment. I think whilst we have seen some indicators, certainly some suggestion that core CPI might be pushing up at that 2.4% level. Other market-based measures of inflation are just not that high, and if you look at inflation expectations, five-year forward, for example, they're very low, and I think the sense is that inflation's not going to run hot. The Fed therefore won't need to hike rates, and it's happy where it is. So the market took it as a positive signal for risk. The only, I guess, question marks are that we just don't know exactly what the Fed thinks is going to happen next. We had two dissenters. The same dissenters that have voted against all the other cuts have voted again not to cut. And there are some question marks that maybe the Fed has just gone a little bit too eager in cutting. It didn't necessarily need to cut this time. The yield curve is no longer inverted. The equity markets are at all-time highs. Although some of the macro data has certainly softened a touch and growth has slipped below the 2%. Overall, US consumer remains pretty strong and resilient. So some of us have suggested that really maybe the Fed could have waited. That would have encouraged the wrath of President Trump, of course, but it could have waited just to keep some ammunition in the toolbox for a potential downturn down the line. Mohammed El-Erian, the respected commentator, saying as such yesterday. Diane Swonk, another respected commentator, she was on Radio 4 this morning saying exactly that. So I think there is a sense that maybe they've gone a little bit too big with the cuts, but on the whole, they are done with these cuts for now. Market sort of risk on. We saw the S&P close at an all-time high. This candle here down on the 1 hour chart on the S&P is because of trade concerns. China starting to sound a bit less happy with the US in terms of its trade negotiations. Something that we flagged in our morning note, that the pressure from Donald Trump to put agricultural imports as a key plank of the phase one trade deal has started to rile the Chinese, and the noises that we're hearing on trade are not quite so positive. If we look at commodities, so gold rallied off the back of the Fed rate cut. Lower yields mean less opportunity cost of holding gold, and therefore gold goes up. And also we saw the US dollar fall, so the net effect of that is very positive for gold. It's up at 15.05, so it broke higher again because of that trade concern as well. So gold benefiting from a triple whammy of lower US real yields, lower US dollar, and haven flows because of trade concerns. So gold rallying into that and potentially looking at a push up back up to that high at 15.15. So on the whole, the Fed has cut, but it's not going to cut any more this year unless things get materially worse. If there's a blow up in the trade war, then we could get a cut by December, but otherwise don't expect the Fed to be raising rates anytime soon. And so that's it for now. We'll be back later on. We've got our earnings special coming up soon to look at all the latest earnings releases. But otherwise, thanks for watching.